Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. And joining me today is Matt Knoll, one of our senior portfolio managers. Matt, in the most recent Market Share, we talked about the United States government getting downgraded from AAA to AA+. This week, we're going to continue on the theme of talking about credit. And the big credit news that we are talking about right now is credit card debt. Recently, there was a big number announced, $1 trillion in credit card debt for the consumers. What does that mean for consumers and the economy as we go forward?
Thanks, Paul. So when we look at consumer credit card debt, really back into the late 1800s and early 1900s, there wasn't a whole lot of credit card debt being used by consumers. Not until the roaring 20s did we really see kind of an explosion in debt used by consumers, particularly for newer products that came about, washing machines, refrigerators, and cars. So consumer credit soared to $105 billion by 1970, and now it stands above $1 trillion. This underscores kind of how debt has evolved from being frowned upon to becoming integral to our daily life. But as we can see in the chart, from the end of 2019 until the middle of 2021, credit card debt went from nearly $1 trillion down to $770 billion. So this substantial drop during the pandemic came as government stimulus payments were sent out and used to pay down debts. The recent increase is simply a return to the long-term trend. It's also worth noting that the economy, household net worth, and equity in homes have all outpaced the growth of credit card debt since the pandemic. As we can see in this table, since the end of 2019, the U.S. economy has grown by 24%, or household net worth by 28%, and home equity by nearly 48%. So all of these have outpaced the growth in credit card debt, which was less than 8%. Even basic wages have grown faster than credit card debt.
That's actually really good news when we think about it from an economic perspective. The other big news that's going to be impacting consumers is that student loan repayments are going to begin in October. That's been a topic really for about 3 years because that's how long it's been since they've had to make payments on student loans. So what kind of numbers are we talking about when it comes to student loan debt?
So student loan debt is pretty interesting, a spot that really could have a big impact on consumer spending in the economy. According to data from the Department of Education, there are about 46 million people in the U.S. with student loans, totaling $1.7 trillion. 90% of that is federal loans, so it is a big, big number. As we see in this chart, that amount is more than credit card debt and auto loans, about 70% bigger than credit card debt and 15% larger than auto loans. So it's substantial. On average, monthly payments are $400 a month for student loan holders, which is a bit more than $200 billion annually. If consumers cut their spending by that amount, it would cut in half the consumer spending growth rate, which would have a significant impact on the economy. There are some offsets to this, though. Despite the risks, households still have excess savings, albeit they're getting on the low side there. Plus, the distribution of student debt loans isn't evenly spread. It's concentrated among higher income households who are better positioned to manage the payments, and there are various new repayment plans available which could soften the blow.
Once again, not great, but also not terrible news as we think about the economy going forward. We truly understand here at First Source the importance of credit, whether it be government credit, corporate debt, or the debt of the consumer. It does drive our economy, so they are important statistics for us to follow and understand the trends. As always, we appreciate the opportunity to serve you and your family, and have a great day.